How do dividend investors make their money? It's a little more detailed than just picking a dividend stock, holding it, and getting the dividend. There's a little more to it. We're going to talk about those details in this video for people who are considering the dividend investing routes. And we also do talk about options trading and covered calls, which is another great way to build up income. I'll be doing a more detailed video soon on that side of things. But in any event, make sure you subscribe to Beat the Market so you get more videos just like this one. So when it comes to dividend investing, a lot of people do just see it as you look at a stock's yield, and if the yield is attractive enough, you buy into the stock. Now, some companies like Apple and Microsoft have very low dividend yields, and that's okay for a lot of dividend investors who are more on the dividend growth side. You see, there are two types of investors: a dividend growth investor, where you're okay with taking on a little bit of a lower dividend right now, like a 1% yield or maybe even a 2% yield. But in return, you expect the company to grow its dividend each year at a faster rate than a more mature company. So if you look at a company like Texas Instruments, for example, that is consistently raising its dividend for the past few years, it's been raising it by roughly anywhere from 12 to 15% in a given year. So if you were earning $100 each year from Texas Instruments dividend, it turned into $112 a year later, and then 124, a little more than that a year later. And just from having the same shares. So when it comes to earning from dividends, people do look at that growth rate, because if a company is able to maintain a 10% or higher growth rate, you could be talking about a 50% dividend growth rate in the course of a few years that isn't entirely reflected in the yield right now, but it is something that you could look forward to in the future. Another thing that dividend investors look at, they look at the yield, but they understand that that yield number actually doesn't matter as much as people think it does. You see, the way that people get dividends is it's a set number that influences how much dividends that you're going to receive. Like, the dividend yield changes based on the stock price, but no matter how much the stock moves up or down, it is a set dividend payment that the company decides to issue out in most cases each quarter. So some people, they wait for a stock to go down in value and they will buy more shares to capture a higher dividend yield, even though at the end of the day, it's the same dollars per share per quarter that they receive in dividend. So this is why people, and dividend investors especially, they buy on the dip, because you're getting more shares. Like, the game of dividend investing, get as many shares as possible. Because if you have more shares, you receive more dividend, and then all of that extra dividend can be reinvested. So not only do dividend investors make money when they initially buy the stock, and when each year a lot of good companies, they will raise the dividend in a way that you reward shareholders, but you also get the reinvestment that you can turn into extra shares. A lot of new dividend investors, they get a fractional share, because you have to, like, if a stock is $100, you have to make over $100 in dividends to get at least one share of that stock each time they issue a dividend. And as the stock price continues to go up, the dividend yield gets a little smaller. So this is where investors, you always want to have multiple options available and find the stock that offers an attractive yield in that given moment and get in at a desired price. Now, some investors, they value the idea of having the bird in the hand versus two in the bush. And these are the income investors. While in theory, Texas Instruments, they keep raising their dividend each year, and they can, maybe continue on the trajectory, there's going to be a point where a company like Texas Instrument, or any company, they're not going to be able to keep on raising their dividend by 10% each year because revenue has to keep on growing by that rate. And then their net profits also have to keep on growing at that rate. Like if you have revenue that grows by 20%, but you have expenses that grow by 30%, it's going to be harder for a company to continue to raise the dividends without getting into debt, which then makes that company a little more dangerous and their dividends a little bit on shaky grounds. Because if you're using debt to pay off the dividend, and you have a very unattractive payout ratio and overall business model, because a dividend is an expense that the company only utilizes if they have the money and they don't know what else to do with it. So again, that's another thing you got to think about dividend stocks. And it's another thing you have to think about if you are in the income investor route. While dividend growth investors are okay with a company maybe 1 to 2% yield, but very promising future, a lot of stock price appreciation, the income investor wants that bird in the hands versus two in the bush. And they will go for a stock that currently has a 4% yield, 5% yield, 6% yield. Now, the higher you get with a yield, in a lot of cases, it means the stock price, it's been getting hammered lately. Now, sometimes this is a compelling buying opportunity. Maybe it's like, one of those sale prices. But you do want to be careful with a high dividend yield because sometimes it could be a high yield trap, which pretty much means that yield is high for a reason. A lot of people are abandoning the stock. Why? For good reason. Maybe the company has a lot of extra debt and there's a lot of concerns about, can that company pay off debt? Can the company continue to grow? Are there enough catalysts to support the company's future? And these are concerns you should be looking at for any company, but the high yield, it is something where people sometimes overlook the fundamentals and they think, oh, this company continues to pay its dividends, it continues to raise its dividend. What could possibly go wrong? This looks like a recipe for success, and it looks pretty good until it isn't. So it's always good to do due diligence on any stocks, but for high yield stocks, they are usually high for a reason. They carry some extra risk, or there isn't too much appreciation left. Because if the dividend is a very high payout, again, it means the company is saying, we don't really know how to use this money, so let's just give it to our shareholders. That's why you look at Amazon, you look at Shopify, you look at a lot of these growing companies, and they don't offer dividends. Apple and Microsoft, they are growing companies. They do offer dividends, but they aren't that much versus a company like AT&T, which there aren't as many growth catalysts remaining, but they do offer a very high dividend yield. So it is something that you want to keep in mind, like, why is this yield so high? But dividend investors, the true benefit of it is being long-term. You're not going to see the life-changing results in dividend investing if you just hold on for a year and then abandon. You may miss out on the growth stock rallies like Fastly recently or Pinterest. I feel like I'm really bullish on Pinterest. I'll just put it that way. But it's 5 years, 10 years where the dividend payments, because companies raise them each year, within the span of 10 years, not only are you reinvesting and you're buying more shares through the dividend, but the dividend within that time could see a 20% increase, a 30% increase, a 50% increase. Some companies in 5 to 10 years, that is enough for them to double the quarterly dividend payment. And this is something that does end up getting taken out of the price of the shares because it is an extra expense that the company has to incur. If a company offers $1 per share in dividends and that's their quarterly payment, the stock price goes down by $1 per share. But it is this idea of having the consistent passive income coming in that makes dividend investing so attractive. And unlike options trading, which we do talk about on this channel as well, dividend investing, it is truly passive. With options trading, you do have to pay attention to the price movements. You have to decide how much you want to make in premiums, whether it's weekly premiums you want to sell via covered calls and cash secured puts or monthly premiums that are a little further out of the money, there's more choices in decision making and being active with options trading than there is with dividend investing. And that's why dividend investing is really attractive for people who are nearing retirement. It also can be very attractive if you're just looking to pay the electrical or pay some of the small expenses around the house. So dividend investing, it is something where you do want to make sure you reinvest. You do want to make sure you are committed to the long term if you do want to apply a strategy. And you can use something like covered calls to increase your return a little bit. So that is pretty much just a very brief summary as to how dividend investors make their money, some of the different choices that are available. If you guys want to learn more about dividend investing, if you want to learn more about options and the stock market in general, just different investing stuff, make sure you subscribe to Beat the Market. We are a relatively new channel and looking forward to providing you guys with more content. Until the next time, dream big, achieve greatness, and unlock your potential today.